Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. You know, we saw investors actually inject about $6.2 billion in the conventional fund business, and this is for the week ended September 26, 2012, even after they learned of a 5-day losing streak for the S&P 500. This is the first 5-day losing streak that we've seen since late July, and as from a cumulative point return, we saw about 1.85% drop in returns. Well, this is because we know investors were actually being, very concerned, tight to the TV, looking at protests in both Spain and Greece. They also had an issue with a fiscal cliff coming up, so everybody's concerned about taxes and actually layoffs due to the federal government having to cut back on their spending. And last, we have the presidential election coming in up in 24 or something like that days. But in any case, we saw again investors put money to work. But let's find out where that money went on our macro group to get a better idea of what's going on. Equity funds actually lost about $1.3 billion. We'd expect that with the concerns that we had, and again, a 5-day losing streak with the S&P 500. Taxable bond funds, though, continued on their merry old way, taking about $3 billion. Muni bond funds took in about $600 million into their fund coffers, and money market funds saw about $3.9 billion net new money. So overall, we didn't see a lot of money coming in and out. Those aren't big numbers, but there are some trends worth noting and paying attention to. Let's take a particular focus on our equity funds group. We saw that they lost about 2.2% of their value for the week ended again Wednesday, September 26th. And it's the first week in 3 that they actually saw a negative performance. But if we see for the seventh consecutive week, we saw outflows out of this group. This week it was $1.3 billion. Domestic equity funds saw about $1.1 billion in outflows. And for the third consecutive week, we saw non-domestic equity funds also lose money. They handed about $200 million of money from their coffers back to investors as well. And that's kind of a trend, because what we saw is this risk on, risk off, and we really were in a portion of risk off atmosphere. If we take a focused look at where people were putting money in to the equity fund universe, we saw that the dividend payers once again rose to the top. We had equity income funds taking about $145 million. That's the 15th consecutive week that we've seen money go into that group. And real estate funds, that's been a pariah for quite so many years. All of a sudden there was some interest in their low valuations, pretty good yields, $112 million. Again, not a lot to write about, but again, the trend of having people put money to work into dividend payers certainly has been something we've talked about for quite some time. Well, I've talked to you about the tale of two cities in many cases as well. If we take a look at equity ETFs and their flows, we see that they actually took in $2.4 billion. What a change. So $2.4 billion is the third consecutive week we've seen plus side, or we've seen actually money come into this group. And the primary fund that took that in was SPY, that would be the Spider S&P 500 fund, took about $2.2 billion. And GLD also saw about $0.9 billion net new money coming into their coffers. Interesting. If we look at the bottom, though, this is where we kind of see some dilemmas. Investors were taking money out of the small caps. So we saw iShares Russell 2000 Index actually lose about $1.1 billion. Now, if we take a kind of a further look, what actually happened in the equity market? Well, hey, this could have been, the money flowing in the SPY could have been actually window dressing. We're at the end of the quarter. Some of the fund managers might want to get some of those bad portfolio holdings that they had, get rid of those, send them away, and then reallocate to Spider. So it could be that we saw a little bit of window dressing as well. So we'll have to see what happens as far as trends go overall. But one of the things we did see is that there was an income play as well. And let's take a look at some income plays as well, going into our fixed income universe. For the 16th consecutive week, we've seen inflows into this group. This time we saw about $3 billion net new money come in. This is the first week in 6, however, that we actually saw minus performance, negative performance, and that was 0.26%. So it wasn't a big drop, but again, it was something where we say, okay, investors were actually pulling back a little bit, maybe taking a little of those hard-won profits off the table and being conservative. So one of the conservative plays we saw was the corporate investment grade debt funds taking about $1.8 billion. This is the 15th consecutive week that they've seen that new money. And on the conservative side, we saw the government mortgage funds taking about $627 million. That is something kind of new. Now, on the flip side, we had been talking about high yield funds, and high yield funds basically have been seeing inflows for quite so many times, and I think we're right around our 16th or 17th week for flows into the high yield funds. But this week was the first week we've seen, and again 15 or 16 weeks, where we saw outflows, and that was for about $500 million. So investors were taking a little bit of risk off their portfolios, even within the fixed income universe. Let's take a look at exchange traded funds and how they did. They took in about $1 billion even, and we saw corporate investment grade debt funds take in about $500 million. That was a big group. But if we take a look at the individual shares, iShares iBox High Yield Corporate Bond Fund, that basically took in about $28 million of net new money, not a lot of money. And then we saw the iShares Barclay Tips Fund taking about $130 million of net new money. So again, very small. And that was one of the issues that we were kind of focusing on for a while. Now, at the bottom of the group, though, we saw what's been there for a while. So again, while people were taking risk off their portfolios, basically, we saw them also avoiding treasuries. There's just not enough yield in that as well. But at the very bottom, we saw J&K at the bottom losing about $0.12 billion. So just a small amount of money flowing out of that group. Well, that brings us to kind of the interesting area that we've been talking about for quite some time. Muni bond funds. For the 24th consecutive week, they've taken in money once again. This is the second week in 3 that we've seen positive performance, about 0.43% as far as our performance goes, but the net new money that came in was about $577 million. Doesn't sound like a lot of money, but really that's a good number, and we've been seeing the 200 to 300s, occasionally 1.1 billion, whatever, but really 577, 600 in that area, good numbers as far as going in. National munis, so about $521 million, and that means all the rest went to single states as well. Well, that's where the story, I think, is the muni bond funds basically taking in money, and it's because there's a couple things going on. Remember I said presidential elections coming up, we have a fiscal cliff issue going on. People are concerned about taxes being raised, and in addition, they're still looking for yield. And yield has been very strong in the muni debt fund area. We've actually been running the tax equivalent muni yields and finding that their yields are higher than their taxable brethren. Again, on a tax equivalent basis, not on a before tax basis. Well, let's take a look at money market funds. There wasn't a lot to be said in money market funds. About $3.9 billion of net new money came in there. It's the third week in 4 where we've seen inflows. Taxable money markets took in about $5.5 billion, while tax-exempt money markets saw about 1.6 exit their coffers. But the breakout is significant here. Money market, actually, institutional money markets saw about $6.5 billion in net new money coming into their coffers, while we saw retail investors actually take out about $1 billion as well. So I don't know if there's a trend that we're going to be able to talk about. Remember, we're at the end of quarter, and there's a lot of quarterly payments, so we expect that there's a lot of managers out there and a lot of corporate treasurers that are probably putting money to work into the money market funds for short holding periods and then putting it back to work either in funds or paying it back out to their corporate clients, whether it be internal employees or whether it be other vendors that they're going after. Well, this is really where we come to the end, but we had some really interesting news up here over the last couple of days. We had better than expected jobless claims. We saw the initial jobless claims declined by 28,000, which is a great number to see. It came in around 359,000 people. This was a good trend to see. We also saw that corporate spending, spending, July consumer spending, and also income increased this last month. And the last piece that we heard this morning, and it just came out, is basically we saw that the bank stress tests out of Spain came back up positive, so the markets are actually turning more positive now. They're actually down on the decline for a while. So certainly we're going to see some, I think, good flows coming in if that positive image continues on. Well, we'll not know, and till next Wednesday, you guys can pop back here and do a little bit, a little bit more research with the research analysts actually covering that position, or you can go to our lipperusfundflows.com site and do a deep dive in areas that you're concerned about. Well, until next time, my name's Tom Roseen, wishing you the best in your wealth planning and creation.